Shreyas Devalkar joins us, Senior Fund Manager with Axis Mutual Funds. Shreyas, good morning. Thank you for joining us. Makes sense for us, my friend. When we went home on Thursday, chins were down, spirit was down. You come back on a Monday, everyone is saying trade war is over. What is happening? How should one invest or trade in this market?
True. So a lot of volatility, and actually, it's at the stroke of pen. Multiple decisions are multiple tariff structures is changing, and on that, it becomes very difficult for the businessman, obviously, to take the decisions so actively and proactively. So what it is leading to is obviously indecision, maybe at the end of global corporate sector, and the repercussion for us as an investor, obviously, is how it impacts our various sectors. So my opinion is broadly, when it comes to 1 year impact of all this trade war, the way it is on the earnings of the company, it looks like that market is in sync with factoring in of that 1 year impact, whether it has a longer term impact on the recession, slowdown, etc. That need to be seen. So from that point of view, in my opinion, the large caps especially, and the segments where there is a least impact, and most of them are in the large cap, that looks fairly priced as such. As far as mid and small cap are concerned, actually they were extraordinarily more expensive by September of 24 because of their growth, theme, story, etc. And that extreme valuation had to get corrected for some reason or other. So with this as a reason, probably you are seeing good correction in that. Whether it's sufficient or not, in my opinion, in bulk of the cases, it is not sufficient. Still, there is a room for further valuation correction. Having said that, the stories, the growth remain good, better than the large cap in mid cap and small cap segment. But it's just the valuation correction which was warranted. Probably 60-70% of it is already done, but still some part is left in that valuation correction. So one need to look at from this point of view.
Okay. How do you see the sequence of events now panning out for Indian markets? Do you think first there would be downgrades, there would be price cuts by brokerages, and then markets will start rallying? What will change and how will things change for us to understand the trajectory of news as well as equity markets now?
Sure. You raise an interesting point of downgrades. Actually, what is observed is actually earning downgrades are at the street level are following the stock price falls. Right? So you may see earning downgrade, but already stock prices have fallen. So yes, earning downgrades may be there already. I think this quarterly result season, whatever few earning previews you must have seen on the street already published, it's a low single digit kind of growth, flattish to low single digit kind of growth already. With this indecision, what I spoke about at global corporate sector level, it may have impact on the earnings. And in my opinion, whatever downgrades have to happen for FY26 because of this indecision, in my opinion, that has broadly got in price because stocks have already fallen. It's not that market is waiting for the earning downgrade to take place. And the call for investor today is FY27 and broadly whether this slowdown, which is going to get further worsened for FY27 also. So in my opinion, yes, there will be downgrades, but in my opinion, some of them is in price only to the extent of valuation re-rating, which has happened. The way I'm looking at, or at a house we are looking at, is wherever the valuations are much more than pre-COVID, whether there are sufficient reasons to justify it. If there are sufficient reasons to justify it, well and good. And I think that stories and that themes and that growth rates is sustained. But if there are not sufficient reasons, it is not backed by the earning growth numbers, then probably you may see some downside out there. As far as the news flow, as I said, apart from the downgrade, there is obviously the slowdown and fall in the energy prices, the fall in the imported inflation for India. That will get highlighted. It will have its impact on the outlook on interest rate cycle in India. So that can be construed as a good development, which gives room for both fiscal as well as monetary policy. Fiscal, again, it has its own nuances, but already the budget is just has happened. So we need to look at it after some point in time, how the tax collection shape up over a period of time. So that data points will be watched closely, both from the direct and indirect tax collection perspective over next few months. So that will be important. As far as earnings, as I said, yes, there is going to be downgrade, but in my opinion, market has already fallen, and that's what we are observing when the quantitative oriented funds or quant oriented strategies. What we observed is nowadays the earning growth or earning downgrade is becoming a lag indicator rather than the lead indicator for the market.
Shreyas, India has always been a stock-specific market, and it's going to be, I guess, more so now because you can't really take any sectoral calls, right? Within sectors also, there are going to be some companies which are going to be winners and some not. Tell me, what's your sectoral bias after the churn that the market has seen, and what's really happening across the globe as well? Where is it that you have your overweights and underweights and avoids?
In my opinion, as you are rightly highlighting, it has been stock picker market. Actually, I would call out that the market has been stock picker market for last 3-4 years. With that, there are extremes in terms of valuations. Market understands which are the winners, which are the losers much ahead because of multiple reasons. And the net outcome is that today it's more to do with the portfolio management, and it is to do with the risk reward framework. So if you notice, when in our case also over last 6 months, so even before this tariff war, since September, because of the valuation differential itself, we have been adding to the financial services, pharmaceuticals names, and we have been reducing on the export name, where there has been a China plus one theme, or where there has been industrials name on the capex theme per se. So that trend has been there for us, irrespective of tariff war, and that trend is more driven by the growth at reasonable price, or what you can call it as a risk reward framework basis. Because in mid and small cap, yes, EMS is a great story. Yes, it is known. Whether the power sector capex is a great story. Yes, it is known. The quick commerce is known to be the great story, and so on. Travel, tourism, etc. But then, in most of these cases, it had got more than in price, and that's where the incremental allocations in last 6 months for us had been based on the risk reward framework per se.
Hi, Shreyas. Good morning. This is Shrishti also joining in. But Shreyas, since you say that you believe that most of the FY26 downgrade seems to be already priced in, that seems like to be the case with bellwether IT company TCS, because the earnings were not up to the mark versus the street estimates, but the stock reaction is not that bad. Give us some sense that how are you looking at the IT space overall, since we just have the first numbers coming in from TCS, and they are highlighting that for BFSI, the vertical that contributes the most, the outlook is not looking that bad. But other than that, which are the verticals within the IT space are you looking at, and what is the overall sector outlook?
So, IT sector is very interesting case study when it comes to its valuation as well as its growth rate. So, first decade of this century, the sector grew at 15%, second decade 10%, and now it is sub 5. And the valuations are broadly same. Part of it is attributable to higher payout ratios. Earlier, the companies used to be acquisitive when the payout ratios used to be low. Today, the payout ratios has been really high for this sector. But the sector multiples are around that similar level, what it has been for last 20 years. Now, here, in case of IT, apart from these slowdown expectations around, that normally it leads to indecision and delays in the project. At least the first result and their media comments suggest that they have not seen any delays in especially deals per se, or not major delays, at least if not any as such. So these commentaries have been encouraging, but uncertainties remain. One more angle is also about the AI and its impact, and that, in my opinion, is very important, because there is AI for IT and there is a AI for business. So all of us, our organization, your organization, every organization today are talking about AI, and it's being used for cost cutting as well as for the business improvement. This impact on the IT sector, whether it will be deflationary or it is going to be give it to a bigger pie. At least initially, the way commentaries has been that yes, initially it is going to give them a bigger pie, and the deflationary impact of AI for IT is going to be lesser versus the bigger pie because of the AI for business, which may continue for some time. So in this overall context, I think, if you look at the relative valuation of the sector is reasonably priced. Any further commentary deterioration from here will lead to derating, because as of now, as you said, only one result has come, and so far the commentary has been okay.
Okay, Shreya, so good having you on the show. Thanks as always for your time.
Sure. Thank you.
If you like this video, then like, share and subscribe to ET Now.